Hi, welcome to Debits and Credits Accounting. I'm Julia.
And I'm Sydney.
And we're going to teach you how to do Chapter 11 today, which is stocks. So here's our problem.
On May 16th, Gentine Co. issued cash for 56,000 shares of non-par common stock with a stated value of $10 at 12. And on May 18th, it issued cash for 11,700 shares of $17 par preferred stock at $23.
So you might be wondering what this means, and when you break it down, it's really not that hard. So we have two different types of stock. We have common stock and we have preferred stock. So common stock is paid second, and preferred stock is paid first. So we have to look at the different values for each of these. So since this is no par, it has a stated value of $10, and it is issued for cash at $12. On the other hand, preferred stock has a par value of $17, and it is issued for cash at $23. So when we go into doing the accounts on May 16th, first we're going to do the common stock. Since the company is issuing cash, our account right here is going to be cash. And then underneath that, we have to look at the difference between the par value and the value that the cash is being issued at. So first we have common stock, since that's what we're looking at right now. And underneath that, we have paid in, which shows the difference. For our values, we're going to have to look at the stated value and the value that it's being issued at. So for cash, since we're issuing it at $12, we're going to do 12 times the number of shares, which is 56,000, and that gives us $672,000. To find the value for common stock, we're going to look at the value that it's stated at, which is $10. So our numerical value for this is going to be $560,000. And then to find the last one for paid in, we have to find the difference between the two to account for how much it's gone up. So the value for that is going to be $112,000.
So now we're going to do the transaction for May 18th for the preferred stock. So there's 11,700 shares of preferred stock that are going to be $17 par, but they're being sold as $23. So we're going to do the same debiting account of cash. And then we will have the crediting account of preferred stock. And for this preferred stock, you're going to do 11,700 times the $17 par, which is going to be $198,900. And then now, so you're going to take the difference between the amount that you sold it at and the $17 par, which is going to be $6, and you're going to multiply that by the $11,700. And that's going to be the paid in, which is going to be $70,200. And then you're going to add those two together and debit them in the cash account, which is going to be $296,100. And there's your transaction for the preferred stock.
Hey guys, welcome back to Debits and Credits Accounting. I'm Jacob.
I'm Chase.
And we're going to teach you how to do Unit 12, bonds.
All right, for our first example, a 12% $100,000 bond is dated May 20th, 2016 and issued May 20th, 2016. The bond pays interest semi-annually for 5 years until the bond is paid in full.
All right, so our first step is we're going to show that the bond is distributed. So we're going to credit or debit cash for $100,000. And then we're going to debit bonds payable for the same amount.
It's a credit. And then you got to calculate the interest, which is I equals PRT, which is principal, rate, and time. And I'm not talking about Mr. Hyatt principal. No, I'm talking about the face value. So now we got to do interest expense for the debit. And since it's I equals PRT, it's 100,000 times 0.12 times 6 over 12, because that's the time. It's semi-annually. So that makes a total of $6,000. And that means you credit your cash, because that's your spending money.
Thanks. Lastly, we're going to close the account after it's matured for the full 5 years. So we're going to do the opposite of what we did first. So we're going to debit bonds payable for $100,000. And then we're going to credit cash for the other $100,000. And it cancels out the opening of the bond and closes both accounts.
And now you know bonds. Accounting bonds.